Welcome to this short explainer from MakeMyFinancials about a surprisingly common problem: businesses that look profitable on paper but have empty bank accounts. Over the next few slides, we'll unpack why that disconnect happens, how it creates real operational pain, and what you can do to see true financial health, not just impressive looking statements. So when you open the financials for a growing company, the numbers can tell a flattering story: strong revenues, growing margins, and apparent year on year profitability. The harsh reality beneath those figures can be very different, with stalled projects, unpaid vendors, and mounting cash pressure that leave owners scrambling despite what their statements say. The root of the issue is often hidden in how deposits are recorded. Customer prepayments get booked as immediate revenue, creating an illusion of profit before any work is done. For example, a $10,000 deposit on a $50,000 job treated as income today can mislead owners about available cash when the project actually needs funding later. This mistake sets off a damaging chain reaction. Apparent income leads to tax bills on money not yet earned, cash reserves get depleted, and when the time comes to deliver the work, the funds have already disappeared, creating a full blown cash crisis with delayed projects and strained supplier relationships. The consequences go beyond money numbers. Paper profits often mask real losses in day to day operations and erode confidence. Business leaders end up paralyzed by mixed signals: financial statements that look great paired with operational struggles, making smart decision making much harder and slowing growth in the process. This problem isn't unique to one industry. In SaaS companies, annual subscriptions paid upfront create timing challenges between revenue recognition and cash needs. Large IT project deposits can vanish before development starts, and construction firms often record progress payments as income before materials are even purchased, creating the same dangerous mismatch. It also hits smaller service businesses just as hard. Roofing firms can find customer deposits eaten by tax bills before the first shingle is laid, and marketing agencies often treat retainers as immediate income while campaign costs arrive later, leaving firms short when they need to execute client work. The impact is measurable and meaningful. Roughly three-quarters of growing businesses report cash flow confusion, more than half experience project delays tied to working capital shortages, and many struggle to maintain vendor relationships due to payment timing issues. These percentages represent real companies facing daily uncertainty about their true financial position. The right accounting treatment fixes the timing mismatch. Instead of recording deposits as immediate revenue and paying tax on unearned income, deposits should be recorded as deferred revenue on the balance sheet and recognized as work completes, so taxes are paid only on actually earned income and cash is preserved for project delivery. Breaking the cycle starts with a few practical steps. Identify misclassified deposits and prepayments, reclassify them as liabilities where appropriate, and implement clear revenue recognition rules tied to work completion. Pair that with regular reporting that separates cash position from profit, and train your team to understand the difference between cash received and revenue earned. The deposit issue is only one part of a larger story about financial clarity. In the next episode, we'll dig into the deeper obstacle that keeps business owners from seeing their true performance and show how fixing that blind spot can transform how you run your business. Stay tuned for episode 2 to uncover the missing piece of financial clarity.